gentlemen, sorry I will speak in English. It's really first a pleasure to be here really, not as a Zoom avatar, you know, it's one of my first real mission abroad, so being in Madrid is not bad either. So it's also a pleasure to discuss such essential issues as, capital-backed pension arrangements. And we do have a lot of evidence-based analysis at the OECD, and I will try to share with you some of our main messages in this area. I'm very pleased also to speak after such eloquent speakers, Angel, Petra, and Guillermo. So I would like to contribute by three main messages. First, the importance of pension funds and retirement arrangements backed by assets, which contribute to ensuring adequate retirement pension outcomes. Second, how capital or asset-backed pension arrangements can ensure fairness and inclusion, and the lesson learned from the COVID-19 crisis. And third, the need for pension funds to take into account the ESG factors and risks in their investment plans to ensure a better economic recovery and a better future altogether. So as some of you may know, at the OECD we are currently reviewing our core principles of private pensions regulation, as well as the OECD roadmap for the good design of defined contribution pension plans. And one main objective of these revisions is to integrate better this ESG discussion, as does the IOPS 2019 guidance on ESG. Asset-backed pension arrangements or capitalization mechanisms to finance pensions are essential for a diverse and well-balanced pension system. It has been discussed a lot by the previous speakers. They can also help increase national savings, reallocate them towards long-term investment. And in the current situation, that's quite fundamental. It has also several advantages that were already discussed by previous speakers, like reducing the need to borrow abroad, as Angel said, and reducing thus exchange risks. Second, it can contribute to the development of financial markets, it was also discussed. And third, it provides valuable long-term funding for the economy. However, as you all know very well, there are a couple of prerequisites to reap these benefits. First, pension funds should only invest in government bonds when it is in the best interest of their members, as recommended by the OECD core principles of private pensions regulation. In practice, this means that investments in government bonds should be made if they provide the best risk-adjusted returns, taking into account concentration risk, obviously. And in addition, governments should use the funds collected through bonds to increase productive capacity, productivity, and GDP. The good news is that capital-backed retirement arrangements have grown in most OECD countries in the last 2 decades. And as you can see on the slide, maybe you will see it soon, the OECD report on pension markets in focus, which tracks pension markets across OECD and non-OECD countries, shows that assets earmarked for retirement have grown in all countries since 2000. In 12 economies, assets earmarked for retirement now represent more than 50% of GDP, and in 9 others, this is more than 100%, up from 4 countries in 2000. So you can see the big progress in red. This is quite interesting to visualize. This is brand new data, by the way. It will be published next week, so you are the first to see it today. And if you want more information on all this data, my colleague Pablo Antolin is here with me. So this growth in pension capitalization reflects a more diverse and a more balanced pension system across the OECD membership, in line with our key recommendations on pensions, namely to diversify the sources of retirement financing and to treat asset-backed pension arrangements as a complement to pay-as-you-go finance public pensions, not a substitute. That's quite important. Ultimately, these recommendations are designed to increase the resilience of pension systems and ensure adequate retirement incomes for everyone. Capital-backed pension arrangements are essential because they can help address certain key objectives for pension systems more adequately compared to pay-as-you-go finance pension arrangements. For example, financial sustainability and labor force participation incentives can be achieved more easily through individually capitalized pension arrangements, as they have implicit automatic mechanisms. Having said that, one needs to be careful with adequacy problems that may result from the insufficiency of savings for retirement, especially if people live longer. So they might miss the third stick, that was referred by Petra. Pay-as-you-go finance pension arrangements are hardest hit by aging populations, which is an increasing trend around the world. This is because in jurisdictions with an aging population and a shrinking workforce, there are fewer workers contributing to future pension benefits. This is quite obvious, it's mathematics. These trends are likely here to stay, that's for sure, given the ongoing improvements to mortality rates and increased life expectancy, which is good. So pay-as-you-go public pensions, as a result, are facing a very serious problem of financial sustainability. Turning to my second point, the key message I would like to leave with you is that capital-backed pension arrangements should be inclusive and available to the population as a whole. The OECD just published a report on how to improve the design of capital-backed arrangements with a particular focus on the pension gender gap, and this was referred by Petra. The report is called Towards Improved Retirement Savings for Women, and this is a major gender gap, the pension one. Addressing these issues requires a multi-pronged strategy. First, women need a better access to retirement savings plan and encouragement to participate in them. It's also important to increase the level and the frequency of contributions by women, while also better accommodating their career patterns that might be different than ones of men, for example, by improving the portability of plans. That's critical. And then more work can be done also on encouraging more measured risk-taking by women that are apparently taking, on average, less risk than men. I don't know if it's true. I've never been convinced of that, but let's say it's true. So that's to improve their investment returns on their saving. Financial independence of women also can always be improved by encouraging and facilitating the split of retirement benefit entitlements and retirement assets between spouses and upon divorce. That's a very important issue. And finally, women's longer than average life expectancy should be taken also into account. For example, by promoting payout options with survivor benefits or with indexed payments. So I could not finish my talk without referring to COVID-19 and its impact on retirement savings. The OECD has done a lot of work on this, reflected in Chapter 1 of our latest OECD Pensions Outlook that was published last December. One of the key things we have learned from policy responses to the pandemic in the area of retirement saving is that early access to retirement saving should be a measure of last resort. And it has not been in some countries, as was discussed also by Henry. That is to say, individuals should be given access to their savings funds only when they are really facing significant financial hardship. I would lastly like to briefly touch on how pension funds can contribute to a sustainable and inclusive recovery and future post-COVID by incorporating ESG factors and risks into their investment strategies. We at the OECD have also been working on these issues, obviously. Our main recommendation is that pension funds should consider ESG investment opportunities and incorporate them into their investment strategies, but only if this is in the best interest of members, as we state in our core principles of private pension regulation. That means that ESG investment opportunities should be adopted if they provide the best risk-adjusted returns, net of fees, once again. But let me comment a little bit on this kind of generic recommendation. I think that 1 week ahead of the COP26, maybe we should put a focus on climate change and argue that in general, dealing with climate change is in the best interest of members of pension funds collectively. So clearly a focus on the climate change, on the E of the ESG is an urgency. Maybe Pablo won't be very happy with me saying that because we are having a very regular conversation on that. But so incorporating ESG factors and risks in their investment strategies of pension funds is possible when there are appropriate market structures and financing instruments, suitable investment opportunities and safeguards also, so that providers act in the best interest of their members. And the OECD core principle, once again, provide a framework for those safeguards. But let me tell you here that at the OECD, of course, we are working on this issue because it's a fundamental issue. It's an urgent issue. We need to make sure that markets can properly, invest, that investors could invest properly, managing the risks in these, especially in these opportunities, environmental opportunities. So what we are doing at the OECD, we are, of course, gathering forces to tackle this problem for all its different angles. On the financial markets, of course, we are working to somehow solve the alphabet soup of these ratings on ESGs. We need to have proper definitions, we need to have proper methodologies, proper transparency, make sure that the E pillar of ESG ratings does align with good transition strategies. We need also to work on harmonization, on taxonomies, etc. And that's what we do. We have embarked into developing an ESG risk policy framework to help the market move in this direction. And of course, we are also contributing to the multiple initiatives on that, private sector ones or like more multilateral ones. We are, of course, working with the FSB on that, with the IFRS, with the NGFS, etc. And we are also tackling that from the corporate governance perspective. We are currently also reviewing our corporate governance principles to make sure that the companies in which pension funds invest disclose proper information on ESG, because that begins here. You cannot have proper information for your investment if the companies don't disclose proper information. And also to make sure that the boards in these companies do tackle with this issue in priority and have accountability for that. So yes, I do think this is a priority, but the market is in full transition. And at all the levels of the investment chain, you need to make sure that this is doable and so that we can invest properly with a good risk management into this. So let me end my talk by summarizing my main messages. First, capital-based pension arrangements need to be inclusive to account for gender differences and incorporate ESG factors and risks in their investment strategies, following the framework provided by the OECD core principles in private pension regulation and the OECD roadmap for the good design of defined contribution pension plans. Second, capitalization mechanisms to finance pension benefits, asset-backed or funded pensions, have grown in importance over the last 2 decades in OECD countries, as we have seen on this slide. This has led to a more diverse and balanced pension system in line with the OECD main pension messages of diversification of the sources to finance retirement and to enhance asset-backed pension arrangements as complements to pay-as-you-go public pensions. Third, the growth of capital or asset-backed pension arrangements increases long-term savings, reduces the dependence on foreign borrowing, and increases productivity and GDP, leading to a virtuous circle. And lastly, population aging has a more direct and bigger impact on pay-as-you-go financial public pension arrangements. So, muchas gracias.